What is up, people? So this video is going to be about taming the markets. Now, there's an idea out there called max pain, where option chains are basically moved to where they need to move, or stock prices are moved to where they need to move in order to make retail investors lose the maximum possible amount in whatever option chain you are trading. Now, I have a couple strategies I'm still working on. E-Trade's paper trading account was glitching this morning, but I should be back on tomorrow. But before that happens, I want to go over this strategy with you guys real quick and show you guys basically how to, like, you're either going to make a lot of money or you're going to force the market makers to trade the market sideways perpetually. And I want to show you guys what that looks like. So this is the strategy that you should do every single day before market close, and then look to close at every single market open. Now, it's pretty simple. So this guy expires tomorrow, right? The prices that I'm going to show you look a little bit better if I wait the 3 hours till close. And so if I wait like 2.5 hours or 2 hours and 45 minutes and then make this trade, it looks a little bit better. But this is the idea behind it. So let's just say that I come in and I buy this guy. Well, a 1% move is roughly $4. And basically, I'd make 200% of my money. I'd be able to, like, if I bought this at 24 cents at market close and it moved up 1%, then I would make 74 cents when I close it. So I'd make 300% of my money. Or sorry, I'd make 200% of my money. So 24 into 74. Now, if I buy this guy at 23, 1, 2, 3, 4, this guy, I make a little bit over 100% on my money. So we know anything over, like, so if this guy goes down 1, 2, 3, 4, so 1, 2, 3, 4, it would be at the 390. So we know that I lose at market open. If the put goes up 100%, I lose 75% on the call. So it'd be a net 25% gain. If I have $100,000, the way that you should trade this is put 10% in each leg every single day. So basically, if I have $10,000 on each side, then this side drops to $2,500 while my put side gains to $20,000. I can cash out for, I guess it'd be a little over 20,000, probably about 22,500. So I'd be able to cash out somewhere around $25,000, which is a net $5,000 profit. Now, obviously, if it goes on the call side and I make that 200%, my put side would still only lose 75%. So if we went 1, 2, 3, 4, it'd go from 25 cents to 9 cents. So I would only lose, roughly 60% of my money, where I gained 200% on the other side. So one side went from 10,000 to 30,000. The other side went from 10,000 to, let's just say, 3,000. So now I can cash out for $33,000. Now, obviously, I invested $20,000, so that's a $13,000 profit. If I have a $100,000 account balance, that would be a 13% profit on the day. Now, if it decided to run 2% in a direction at market open, so you know how sometimes we open in the markets and we're negative 2% or positive 2%? It's rare, but it does happen. Well, in that case, I really can't lose any more money on the other side, While the side that's winning, instead of getting 57 cents, it'd get $1.27, so I'd make 400% on my money over here. And you can see how exponentially it increases your reward. Now, if we look at an example like today and yesterday, so the futures ran to 0.75% on the SPY, 0.75% positive, and it ran to negative 75%. It ran to negative 0.75% in the futures before open, and then at open it basically opened sideways. Well, if I came in and I bought these options that have 1 day to expire and the market closes and the futures open, if it runs up 1%, I already know that I'm making money. And so what I can do is I can come and I can basically, if it runs up 1%, then I can short the futures, saying that if it comes down, my futures make a profit. And so what happens? Well, we go to market open, and either at market open, the price is going to drop and it's going to be at the 0.00 level. Well, if I sold the futures, then when it goes from 0.75% positive and right at the open it crashes down to where it's break even for the day at the open as of yesterday's close, well, now I made profits on those future money, while I'll be able to cash out these options immediately at open for almost no loss. Like if I do 10% on each side of my account balance, I should expect to lose up to about 2% of my account balance. So basically, if I do 10,000 on each side, I should be willing to lose about $2,000 just by opening the trade the day before and closing it right at open, assuming there was no market movement. But again, if the futures run and I short whatever side against it that it's running, if it opens at that 1%, that when I started shorting, I didn't lose any money on my futures. I still get all my profit on the call options, so I can close all the positions for the profits that we already talked about. And yeah, so basically you're basically, in this sense, if enough people were doing this, you would force them to never let futures go crazy anymore. And so if you believe that they use futures to create fear, uncertainty, and doubt inside your trades, well, this is a way that you can risk very little amount of your account. On the best days, you'll make 20, 30, 40, 50% of your total account balance just at open. And on regular days, like on a regular occasion, you'll be able to at least make money on the future side. Yeah. So that's how you should be thinking for every market open and close. I think everyone should be doing this trade all the time. The only thing that you need access to besides your day trading account is your futures account. And like basically, if I did, let's just say I did 10,000 on each side. If the futures run 1% either direction, well, I mean, what I would probably do is if it runs 0.5% in either direction, then I'm going to start half of my short position. So basically, I just, like, if you short a future, like, it will say, like, for every 0.25 tick, you make $5. And so at 0.5%, I can calculate to where if it came down that 0.5%, I would make, and let's just say $5,000 for this example. So if it runs up to 1%, after you short the 5%, you'd lose $5,000 there. But then you short again, another $5,000. And it might actually be half of that because we've only gone half the distance. So we'd probably want to do $2,500 on the 0.5% when you get your first position in. Then when it runs to 1%, then you can throw in the other $2,500 for every 0.5%. And that way, if it comes all the way back down to zero at open, you make $7,500. And then you'll be able to close your call and your put position for basically the same price that you bought them the day before, assuming that it opened sideways. And then obviously if it just keeps running in one direction, 2% positive either direction, you're going to make a fortune. So we don't like, the more that it runs, the better. And even with the losses that you'd make in the futures at shorting at 0.5% and 1%, and then it running to 2%, the amount that you're going to make in the puts is going to be way more than that. So you're not even worried. I think that's all I'm going to... Okay, so I'm not going to go over exactly what I'm going to be doing because I'm still working out the exact details. But ultimately, if we come and look at the SPX, there's an expiration every single day here. On the SPY, there's only an expiration Monday, Wednesdays, and Fridays. And so on Mondays, Wednesdays, and Fridays, we'll be trading the SPY, but on Tuesdays and Thursdays, we can trade the SPX. 37.60 is at the money. And basically, I'm creating a strategy where I can short, I can sell an option at the money, and it might have 1 day to expire, it might have 2 days to expire. I'm still working through it. And I can come in and buy something with more theta. And the way the goal is that anything that one side moves up, the other side breaks even. So if the price moves up, I'd lose money in my selling of the call option. But the call that I buy with more theta, I would gain money. And so the goal would be to break even on that side. Obviously, if it moves down, at a certain point, I'll be making what I'm losing on the other side. But then, like, I got all this, now I'm out of the money, let's just say 1% here. And so, basically, whatever the credit is, I should feel safe about being able to collect that credit. Regardless if the market decides to move back up 1%, it'd still be out of the money. And so it kind of gives you that cushion. And ultimately the goal is that the one with the more theta that I buy, that's going to cause me to break even regardless where this guy moves. The goal is after a couple hours, 3-4 hours, the market's been open, I will have collected a credit if it trades sideways. Now, there's still some questions on what happens if when I'm ready to start executing, it hasn't traded sideways. But the idea is if it comes back down to that price, then for sure I will have collected a lot more theta than I've lost in my higher theta option. And what this allows me to do is basically I'm not allowed to naked sell this call option with just a regular account. You got to have a portfolio margin account for that. But what I can do is I can come in here and I can sell at the 37.60 for today to expire, and I can buy at, let's just say, the October 10th at the 37.60. And the goal is that as you're collecting, like as the market's moving up and down, hopefully we cross a zone where we are back to where we were. And now I've collected theta on this option. I still have more theta to collect towards the last 3 hours of the day. And these options have become so cheap compared to what they were at market open. So like this guy was probably $8 if I would have bought it before close. But now it's only $4.50. And so what it allows me to do is come in here and basically play these lottos, because if this moves $1, $2, $3 up, so a little less than 1%, that's about a full percent right there. I make 200% on my money. Where if this guy moves let's see, that's 1, 2, 3, 4. Actually, I got that wrong. So it's 1. It would be 7 ticks would be a percent. So 1, 2, 3, 4, 5, 6, 7. So that's actually 1% move right there. And that would be roughly 400%, 500% on my money. Where if I sell this guy and it goes 1, 2, 3, 4, 5, 6, 7, I would lose about 100% of my money, a little bit more than 100% of my money. So if I was selling for $20,000 credit, now I would have a $40,000 or $50,000 credit, and only 30,000 of that would be a loss. Well, if I know that I'm collecting this credit, I can basically come in here and I can buy the equal amount that I'm getting here. And so whatever I've made in my theta and whatever I'm expecting to make, as long as it doesn't move against me, I can use those funds to lotto for free is the goal. We're trying to create a situation where we get a free lotto, all the 1 day to or 0 day to expiration options. And basically I can stagger in a position to where if this guy moves, if the option that I'm selling at 23.80 moves against me, the money that I'm making with the lottos is going to be a lot more than what I'm losing. And so it's going to be a matter of just looking at where the how quickly these options become worthless in sense. So for example, like if I came down here 1, 2, 3, 4, 5, 6, 7, like I can almost 10x my money with a 1% move. And so I could come down here and buy a bunch of these because I know that I'm collecting my $22 of credit. And so in theory I could buy almost 20 of these contracts. And obviously if I bought 20 of these contracts and it moved up 1,000%, you're talking about making a $200 credit where you only lost a $30 in that 1% move. And so it's $170 profit, and that's $17,000 actual profit. And so yeah, the goal is to create a situation where I can play the lottos for free. And worst case scenarios, I break even if it just trades sideways at the last 3 hours. And here's the thing, think about the market, think about how much you've watched tickers. How much does the last 3 hours, 2 hours, 1 hours do you see big movements in the stocks? Is it once a week? Is it every other day? And when I say big movement, I'm just talking about 1%. And so I would say it's fairly often. Like you're probably going a week where it happens 3 or 4 times in that week, and then you'll probably go into a week where it doesn't happen anytime that week. And as long as you're breaking even on the bad days, or let's just say losing a small amount, then on the days that your lottos hit, again, you make a fortune. And then there's just one little strategy that I'm still working on that involves margin trading the SPY and the SPX. And so basically selling an SPY, buying an SPX, and seeing the potential in there. It looks like there might be potential in there. And I'll just have to play around with it a little bit more to verify. But that is where my head's at right now. I hope you learned something from this video, and I hope you go make a lot of money. As far as my selling the credits and playing the lottos for free, obviously if I'm able to show you how to break even every day, we'll show you how to profit every day, and then potentially turn that profit into the free lottos. I just think that'd make more than collecting the credit that we would be assumed to receive. And so if I can show you how to make a small credit and then use that credit to play the lottos, then you should definitely follow me on that. But before that, every single day you should be trading massive amount of money on the puts and the calls, and then getting ready to hedge your bets on the futures when the futures start to run every day. And that way, no matter what happens, I mean, obviously, like if the futures don't run either direction and you never get a position on either side, then you would simply just close your call and puts at open when it trades sideways and take a small loss. I think that's all I got for you now. Wow, 21-minute video. It's longer than I thought this was going to be. Well, it's all good news, people. Taking a little bit longer than I'd like. Again, like with this paper trading garbage, it's not exactly what I love. Obviously, I don't have all the abilities to trade as a portfolio margin account, but slowly but surely I'm collecting data that I need to analyze these trades, and I will get answers. And so far I'm feeling very confident that the answers I'm going to find are going to produce massive results, and it's just a matter of perfecting it and working out the bugs that I'm working out. And yeah, I'll be slaying it soon. You can count on it. And then this weekend, Saturday, Sunday, maybe some on Monday, I will be probably going live when I do it, but I'm going to pull up the court, or the complaint that my lawyer has created. Basically, he's written a complaint so far against MULN Automotive, and I am going to go live on my YouTube and basically create a Word document where I start writing things down that should be added to the complaint that aren't there yet, but then also going through each paragraph that they wrote, and if I think it needs a correction, or data or dates are maybe needed correction, or maybe it just needs to be rephrased, or maybe it needs to be taken out. I'll just go through each thing until I've addressed everything I can think of, and then from there the lawyer will finish rewriting the complaint, and then from there we'll have a couple questions that we want a forensic accountant to verify and establish for our complaint, and we'll add that to complaint, and then we'll be ready to file the complaint, and it will be all good news. Lots going on. It's taking a little bit of time, but we'll get there.